Hi there, and welcome to 5 trading tips that can quickly help you become a better trader. So today I'm going to give you 5 hyper-specific tips that can help you improve your trading. Some of these you may not have heard before. How do I know these tips? Well, for the past 5 years, I've taught hundreds of traders with my trademark strategy factory approach to trading and trading system development. And I've learned some of their best tips and secrets. And I'm going to share those with you right now. So let's jump into tip number 1. You should start with 3.5 times the amount of trading capital you think you need. What does this mean? Well, have you ever opened a trading account with only a little bit of money? I know I have. And usually it didn't work out very well. But do you know why it didn't work out well? Well, you could blame the strategies that you were trading. Hey, maybe they weren't so good. Maybe your discipline was poor, and that was the issue. And maybe you just freaked out emotionally as soon as you hit a drawdown and you couldn't stand it and you just stopped trading the system. That happens. But the important thing is, even if you had all of those other things perfect, you could still fall victim to risk of ruin. And that's what's behind tip number 1. So imagine a coin. We're going to flip a coin. If you pick heads, you'll win $1.50 for every flip. And if it comes up tails, you'll lose $1. Okay? So over the long run, you're going to make money with this strategy, right? Because 50% of the time you'll make $1.50 and 50% of the time you'll lose $1. So it's a positive expectancy strategy. But what are your chances of getting wiped out? Well, it all depends on the amount of capital you start with. If you only have $1 in your pocket to play, you have over a 50% chance that you're going to lose and you're going to get wiped out, right? But if you have $100 and you're playing this game, chances are you're not going to get wiped out and you're going to make 50 cents on average over every 2 flips. The secret is you have to avoid being wiped out. So even with a good strategy, you can get wiped out. You have to have enough capital in your account. So there's a couple pretty simple methods that I use and that you can use to help you properly size your trading account. The first one is to take the initial margin that the exchanges require and just multiply it by 3.5. Now, that's just a good rule of thumb. It doesn't really take into account your strategy or anything like that, but it's a good idea, and it will make sure you have enough money in your account to help you weather some of those drawdowns. A better approach is to incorporate the strategy wins and losses in your analysis. I use this with a Monte Carlo simulator. You can get one off my website and you can run it yourself. It's a great way to see how much money you need to avoid this first mistake, which is the risk of ruin. So let's move on to tip number 2. You should spend 20 hours or more a week working on your trading. How did I come up with this? Well, I asked successful students. I asked them, how many hours a week do you spend on average working on trading and developing trading strategies? Here are the results. Most of them spend more than 5 hours a week, and 20% of them spend more than 20 hours a week. And there's a direct correlation between the amount of time you spend and the number of strategies you create. I mean, nobody's going to argue that LeBron James is one of the best basketball players of all time, right? Well, do you think he spends 2 or 3 hours a week working on basketball? Heck no. He probably spends 60 to 90 hours a week working on his craft. So why should trading be any different for you? Don't forget, you're up against professional traders, and they're spending all their time doing it. Shouldn't you dedicate the same amount of time? Trading can't be like this guy, where you set it and forget it, where you just spend 5 minutes a day working on trading. It's a pipe dream. It's not going to work. It's not going to work long term. And People who are serious about trading know they have to spend the time doing it. And like I said, it's because more time spent equals more strategies. So the traders who spend a lot more time end up with a lot more strategies. And more strategies, as we'll see in a little bit, is a good thing. And that leads us to tip number 3, to have 6 or more strategies that you're trading in the market. That's because good traders spread their risk across different markets. It's a neat concept. It's called diversification. Well, in futures, there's 6 different market types: ags and softs, currencies, metals, energies, stock indices, and interest rates. And if you have a strategy in each market sector, you're going to be pretty well diversified, which is important. When I talk to my students, they actually have strategies in 34 different futures markets. That's quite a bit, and it allows them to be diversified. Well, you may wonder, why not just trade 1 or 2 markets? Well, the big reason is diversification. And this has been a concept that's been around for a while. It actually won Harry Markowitz a Nobel Prize. And it just says if you spread your risk in different areas, you're liable to get better results, better risk-adjusted results. Here's an example. The strategy on the left is just one strategy, and you can see it's kind of bumpy. It's going up, but there's drawdowns and that kind of thing. But if you look at the strategy on the right, which is a portfolio of 15 different strategies, you can see it's a lot smoother. And that's because the profits for each individual strategy add up, but their drawdowns happen at different times. So while one is making new highs, maybe another one's in somewhat of a drawdown, and they kind of balance each other out. And the overall effect is to get a smoother equity curve. And that's really what's behind tip number 3, spreading your risk. It's making your equity curve better. Tip number 4 is waiting 6 months after you develop a strategy before taking it live. And you might be shocked at that and say, why do I have to wait? It looks good. I'm going to start trading it. Well, as a trader, you must be patient. Patience is a virtue. You're running a marathon with trading. You're not sprinting, running a race. I know. Back in my younger days, I used to run marathons. I finished 5 of them. And I never started a marathon by sprinting at the beginning, because that would just ruin me for the next 26 miles. You take it slow and you be patient, and that will help out your trading immensely. Here's an example. Here's a back test that I created. Looks pretty good, but going forward, I don't know if it's going to continue to do well. I hope and I think it will. But I want to make sure before I start trading it live. So I end up watching it in real time for 6 months. And if it continues to perform like this one does, then I feel much more comfortable trading it. Here's another example. Same sort of thing where the back test looks good, but you want to make sure it still performs in real time. Because if it doesn't, that tells you might have done something wrong when you developed the strategy. So I asked my successful students, how much has this saved you money by waiting this 6 months? And 88% of them said, yes, waiting 6 months to trade a strategy live has saved me money. So this is a very good tip for you to use. Good traders have a good process for developing strategies that they trade. As an example, the traders I've worked with have created over 300 strategies that have worked in real time. Not just look good in backtest, but they've actually performed in real time. My process has 8 specific steps, but anyone can follow them and develop their own strategies. It's sort of like a recipe. If you're going to cook food, you follow a recipe. It's step by step. And once you know the recipe, you can go on and create that food, and you can make modifications to it and create all sorts of different foods. The key is once you know the recipe, it opens a lot of doors. And it's the same way with developing strategies. Once you know a good way to develop strategies, you can have a ton of different strategies. So those are the 5 tips. First, have enough capital to start trading with. 3.5 times the initial margin is a good rule of thumb. Second, spend at least 20 hours a week working on your trading. Don't think you're going to be a great trader if you only want to spend 5 minutes a day. Third tip is to have 6 or more strategies. You should do at least one for every market sector. And usually the more strategies you have, the better off you're going to be. The fourth tip is to wait 6 months when you develop a strategy until you trade it live. So watch it in real time, make sure it still performs before you go live. And the last tip is to follow a process. Follow a process that you know works and that leads to good real-time results. If you've learned something new from this video, go ahead and subscribe to my channel. And if you want to learn to trade like me, visit me at kjtradingsystems.com. So, which of the 5 tips today are you going to put into practice first? Leave a comment below and let me know what you're thinking. I'm Kevin Davey, and thanks for watching.